Have you ever looked at your tax bill and wondered if you're somehow doing this wrong? Like maybe there's a secret version of the tax code that everyone else knows about except you? Because when you see billionaires paying lower tax rates than nurses, it starts to feel like you're playing a completely different game. And the craziest part? You are. The loopholes these people use are so absurd, so obviously broken, that they sound like something a teenager would make up as a joke. Except they're not jokes. They're real, they're legal, and they save the wealthy billions of dollars every single year. If you've ever felt like the system wasn't designed with you in mind, make sure to subscribe, because today we're pulling back the curtain on the tax strategies that sound too stupid to work but somehow do. Before we dive into the specific loopholes that make this possible, let me paint you a picture of what we're actually dealing with here. Because when I tell people these numbers, they usually think I'm exaggerating. The top 1% of earners in America pay an average effective tax rate of around 26%. Sounds reasonable, right? Until you realize that's just the average. The ultra-wealthy, the billionaires with their names on buildings and their faces on magazine covers, often pay far less. We're talking effective rates in the single digits. Some years, effectively zero. Zero. Meanwhile, a typical middle-class family earning $75,000 might pay an effective rate of 15 to 20%, which means your dental hygienist could be paying a higher tax rate than someone who owns a yacht fleet. Let that sink in for a second. Now, you might be thinking, well, those are just outliers. A few eccentric billionaires gaming the system, and I wish that were true. But the scale of legal tax avoidance in this country is genuinely staggering. We're talking about hundreds of billions of dollars every single year. Not money hidden offshore through illegal schemes, not fraud, just people following rules that were written specifically for them to follow. In one particularly revealing analysis, it was found that the 25 richest Americans paid a true tax rate of just 3.4% over a multi-year period. 3.4%. That's not a typo. These are people whose wealth increased by over $400 billion during that window. And their collective tax bill? About $13.6 billion. That's a rate so low it almost doesn't register as taxation at all. And here's the thing that really gets me. None of this is illegal. Every single strategy they used was completely within the bounds of the law. The loopholes they exploited weren't bugs in the system. They were features. Think about it this way. If you earn a salary, your employer takes taxes out before you even see the money. There's no negotiation, no strategy session with accountants, no 5-year plan to minimize your burden. The IRS gets their cut automatically. But if your wealth comes from assets, stocks that appreciate, real estate that grows in value, businesses that expand, then suddenly the rules become remarkably flexible. Suddenly there are options. The gap between how taxes work for earned income versus investment income is one of the fundamental divides in the American financial system. If you work for your money, you pay taxes on it, period. If your money works for you, well, that's when things get interesting. The total amount lost to legal tax avoidance is difficult to calculate precisely, but most estimates put it somewhere between $500 billion and $700 billion annually. That's not including illegal evasion, just the legal stuff. The strategies that are completely above board, completely documented, and completely devastating to the federal budget. To put that in perspective, the entire annual budget for the Department of Education is about $80 billion. The amount we lose to legal tax avoidance could fund education 8 times over. It could eliminate student loan debt. It could rebuild every crumbling bridge in America. Instead, it stays in the pockets of people who already have more money than they could spend in 100 lifetimes. So who exactly is using these loopholes? That's where the picture gets more complicated than you might expect. Now, you might assume this is just a handful of tech billionaires and hedge fund managers. The Bezos and Musks of the world with their armies of lawyers finding creative interpretations of obscure tax provisions. And sure, those guys are definitely playing this game at the highest level. But here's what most people don't realize. The loophole economy extends far deeper into American life than you'd expect. Your dentist might be paying a lower effective tax rate than you. Your neighbor who owns a few rental properties, almost certainly paying less. That guy from your gym who always talks about his business ventures while everyone else is just trying to finish their workout? He's probably figured out at least a few of these tricks. The ultra-wealthy didn't invent tax avoidance. They just perfected it. The fundamental divide isn't really between the rich and everyone else. It's between people who earn W-2 wages and people whose income comes from other sources. If you get a paycheck from an employer, your taxes are calculated automatically, withheld automatically, and reported automatically. You have essentially zero flexibility. The system was designed to capture your income with maximum efficiency. But if you're a business owner, an investor, a landlord, or a professional with the right corporate structure, suddenly you're playing a different game entirely. You're not trying to avoid the system. You're working within a system that was built with escape hatches specifically for people like you. Those escape hatches just happen to be invisible to anyone who doesn't know where to look. There's an entire industry dedicated to this. We're talking about tens of thousands of tax attorneys, accountants, wealth advisors, and financial planners whose primary job is helping clients minimize their tax burden through completely legal means. This isn't some shadowy underground network. These are respectable professionals with corner offices in every major city, advertising their services openly. The wealth management industry generates over $100 billion in annual revenue, and a significant chunk of that comes from tax optimization strategies. Think about what that means. There's an entire professional class making six-figure salaries specifically to help wealthy clients pay less in taxes. And the reason those jobs exist is because the potential savings are so enormous that spending $50,000 on sophisticated tax planning can easily save you $500,000 or more. It's like showing up to a chess match and discovering your opponent has a team of grandmasters advising their every move, while you're staring at the board trying to remember how the knight moves. And here's the thing that really gets me. Most of the people using these strategies don't think of themselves as doing anything wrong. From their perspective, they're just being smart with their money, following the rules as written, taking advantage of opportunities that are available to anyone with the resources to access them. The fact that those opportunities aren't actually available to most Americans doesn't really register as a problem. But how did these strategies actually work? Let's start with the one that sounds so stupid it shouldn't be legal. Let's talk about the stepped-up basis, because this is the loophole that sounds so absurd you'd assume I was making it up. When I first learned about it, I thought there had to be some catch I was missing. There isn't. Here's how it works. Let's say you buy stock in a company for $100. Over the course of your lifetime, that stock grows to be worth $10 million. Under normal circumstances, if you sold that stock, you'd owe capital gains tax on the $9,999,900 in appreciation. At the current long-term rate, that's potentially over $2 million in taxes. But here's the thing. You don't have to sell it. If you hold that stock until you die, something magical happens. When your heirs inherit that stock, their cost basis isn't your original $100. It's the current market value at the time of your death. $10 million. That nearly $10 million in gains just disappears. It's never taxed. Not when you held it. Not when they inherit it. Not ever. The appreciation vanishes from the tax code like it never existed. Let that sink in. If you had sold the stock the day before you died, you would have owed over $2 million in taxes. The only difference is timing, and that timing erases a multi-million-dollar tax obligation. This isn't some obscure technicality that affects a handful of estates. The stepped-up basis costs the federal government an estimated $40 to $50 billion every single year. That's more than the entire budget of the Department of Homeland Security. And it overwhelmingly benefits the wealthiest Americans because they're the ones sitting on the largest unrealized capital gains. Now, you might be thinking, well, at least they pay estate tax, right? And technically, yes, there is an estate tax. But here's where it gets even more interesting. The current exemption is over $13 million per person. A married couple can pass on over $26 million completely tax-free. And even above that threshold, there are trusts and structures specifically designed to minimize or eliminate estate taxes altogether. So if you're wealthy enough, you can accumulate enormous gains during your lifetime, never pay taxes on those gains, pass them to your children with a stepped-up basis, and if your estate planning is sophisticated enough, avoid most estate taxes too. Your wealth transfers intact across generations, while regular Americans pay taxes on every single paycheck. If you work overtime and earn an extra $10,000, you pay income tax on every dollar. There's no stepped-up basis for labor. There's no exemption for hard work. The money hits your paycheck, and the government takes their share automatically. This is why tax experts sometimes call it the angel of death loophole. Dying with assets is literally the most tax-efficient strategy possible, which creates bizarre incentives for wealthy people to never sell anything. And that's exactly what they do. But the stepped-up basis is just one piece of a much larger puzzle. Here's where things get really creative. And by creative, I mean the kind of financial engineering that would make a circus performer jealous. The stepped-up basis is powerful on its own, but the truly wealthy don't just use one loophole. They combine them into what financial advisors sometimes call the buy, borrow, die strategy. And once you understand how it works, you'll understand why some billionaires can live like kings while reporting almost no taxable income. Here's the playbook. Step 1. Buy assets that appreciate. Stocks, real estate, private equity stakes, whatever. The key is building wealth through appreciation rather than income. As long as you don't sell, you don't owe taxes on those gains. They exist on paper, making you richer every year, but the IRS can't touch them because they're unrealized. Step 2. Borrow against those assets. This is the part that breaks most people's brains. Instead of selling your stocks to fund your lifestyle, you take out loans using those stocks as collateral. Banks are thrilled to lend against appreciating assets, often at remarkably low interest rates. And here's the beautiful part. Borrowed money isn't income, it's debt. So you can access millions of dollars in cash without triggering a single dollar of taxable income. A billionaire could borrow $10 million against their stock portfolio, use that money to buy a yacht, fund their lifestyle, whatever they want. And on their tax return, almost nothing. No capital gains because they didn't sell anything. No income because loans aren't taxable. Step 3. Die. Seriously, the final move in this strategy is death. When you die, two things happen. First, your heirs inherit your assets with a stepped-up basis, wiping out all those unrealized gains. Second, your outstanding loans get paid off from your estate, often using assets that have never been taxed. The net result is staggering. You spend your entire life accumulating wealth, access that wealth through borrowing, live a lifestyle funded by those loans, and pass the underlying assets to your children without ever paying capital gains taxes. The gains disappear, the wealth transfers, the tax obligation evaporates. This isn't theoretical. This is actively used by some of the wealthiest people in America. When you read about billionaires who paid essentially zero in federal income taxes for multiple years, this is often how they did it. They're not hiding money offshore. They're not committing fraud. They're following a completely legal playbook that just happens to be unavailable to anyone who earns a regular paycheck. The sophistication doesn't stop there. Wealthy individuals layer additional strategies on top. Charitable remainder trusts, qualified opportunity zones, dynasty trusts that preserve wealth across multiple generations. Each strategy is legal. Each is well documented. Each has an entire cottage industry of professionals ready to help you implement it. It's a perpetual motion machine for money, and the fuel is a tax code that treats investment income fundamentally differently than earned income. You might be wondering, how is any of this legal? Who wrote these rules, and why do they work this way? The answer is going to make you even more frustrated. These loopholes didn't appear by accident. They weren't oversights or drafting errors that slipped through congressional review. They were designed, intentionally, by people who knew exactly what they were doing and exactly who would benefit. The United States tax code is over 70,000 pages long. Let that number settle in your brain for a moment. 70,000 pages. For comparison, the entire Harry Potter series is about 4,100 pages. The tax code is 17 times longer than 7 fantasy novels, and somehow every page manages to be less entertaining. Nobody writes 70,000 pages of anything by accident. That kind of complexity is a feature, not a bug. Every one of those pages represents opportunities, definitions that can be interpreted multiple ways, exceptions that apply to specific situations, carve-outs for particular industries, phase-ins and phase-outs that create cliffs and gaps. And the people who benefit from that complexity have spent billions of dollars making sure it stays exactly the way it is. The lobbying numbers are staggering. The financial sector alone spends over $500 million annually lobbying Congress. Real estate interests add another $150 million. Add in contributions from wealthy individuals, think tanks funded by billionaire donors, campaign contributions, and the revolving door between government and the private sector, and you start to see a system remarkably responsive to the needs of people who already have money. Here's how it typically works. Someone proposes closing a loophole, say, eliminating the stepped-up basis. Immediately, an army of lobbyists descends on Capitol Hill. They bring economic studies funded by the people who benefit. They warn about unintended consequences. They propose alternative reforms that sound meaningful but change almost nothing. They suggest phasing in changes over decades, giving wealthy families plenty of time to restructure. And if somehow a reform actually passes, the same army of lawyers and accountants who lobbied against it now gets to work finding replacement loopholes. It's like playing whack-a-mole, except the moles have billion-dollar legal teams and the hammer is made of paper. The IRS itself has been systematically weakened over the past few decades. Funding has been cut repeatedly, leading to fewer auditors, less enforcement capacity, and a focus on easier targets. It's genuinely cheaper for the IRS to audit a middle-class family claiming the earned income tax credit than to go after a billionaire with a team of lawyers who will fight every finding for years. The result? Audit rates for the wealthy have dropped dramatically, while working families face scrutiny for claiming credits they're legally entitled to. Think about that dynamic. The people using the most sophisticated avoidance strategies face the least enforcement. The people filing simple returns face the most. The system isn't just tilted in how it's written, it's tilted in how it's enforced. And whenever anyone suggests changing this, they're accused of waging class warfare or punishing success. As if asking a billionaire to pay the same rate as their secretary is some kind of radical redistribution scheme. The system isn't broken, it's working exactly as designed. But here's what really interests me. How has all of this become so normal? Think about it this way. If someone told you they had figured out how to pay almost nothing in taxes while making billions of dollars, your first reaction would probably be skepticism or outrage. But when it's framed as smart tax planning or working with a good accountant, suddenly it sounds almost admirable. The language shapes everything. Wealthy people don't avoid taxes. They optimize their tax position. They don't exploit loopholes. They take advantage of legal strategies. They're not gaming the system. They're being actually financially responsible. The euphemisms pile up so thick that the underlying reality becomes almost invisible. And here's the really insidious part. Many Americans actively defend a system that disadvantages them. You've heard the arguments. I might be rich someday, so I don't want to close these loopholes. If you tax the wealthy too much, they'll just leave. The rich create jobs, so we should let them keep their money. These talking points have been so thoroughly distributed that regular people parrot them without realizing whose interests they're actually serving. The aspirational defense is particularly fascinating. Studies consistently show that Americans dramatically overestimate their chances of becoming wealthy. We live in a country where the median household has less than $10,000 in savings. Yet millions of people oppose estate tax reforms because they're worried it might affect them someday. It's like buying lottery tickets and then lobbying against taxes on jackpot winners. Technically coherent, but statistically delusional. The complexity of the tax code itself serves as a deterrent to public understanding. When something is complicated enough, most people simply tune out. They assume that if it were really unfair, someone would have fixed it by now. They trust that the experts who designed the system must have had good reasons. The sheer impenetrability of tax law becomes a shield protecting it from democratic scrutiny. Media coverage doesn't help. When billionaires are revealed to have paid almost nothing in taxes, the story lasts a news cycle or two before everyone moves on. No sustained outrage. No movement for reform. No political consequences. The wealthy can wait out any temporary attention, confident that nothing will actually change. Meanwhile, regular taxpayers develop their own coping mechanisms. Some become obsessive about small deductions, convinced that if they just find the right accountant, they can unlock the same advantages. They don't realize the playing field isn't just tilted, it's an entirely different game. Others simply accept the situation with resignation, treating tax day as an inevitable unpleasantness rather than a manifestation of policy choices that could be different. The psychological effect is a kind of learned helplessness. People believe the system is unfair, but they also believe it can't be changed. They complain about taxes while defending the structures that make their complaints valid. They recognize injustice but accept it as the natural order of things. It's a uniquely American form of financial Stockholm syndrome. We've grown so accustomed to our captor that we've forgotten we're supposed to want escape. The most depressing part is how rarely this enters mainstream political debate. The conversation has been so thoroughly captured that defending the status quo requires no argument at all. So what does all of this actually cost? Let's run the real numbers. Let's do what most people never bother to do and add up the actual cost of this system. Because when you see the full picture, the numbers become genuinely difficult to process. The stepped-up basis alone costs the federal government between $40 and $50 billion annually. That's just one loophole. Add in the preferential treatment of carried interest, which lets hedge fund managers pay capital gains rates on what is essentially labor income, and you're looking at another $15 to $20 billion. Like-kind exchange rules for real estate defer another $6 billion per year. Qualified opportunity zones, sold as a way to help disadvantaged communities, have primarily benefited wealthy investors to the tune of billions more. When you stack all of these provisions together, the total tax expenditure on benefits that primarily flow to the wealthy exceeds $200 billion annually. $200 billion. Every single year. That's not money being stolen or hidden offshore. That's money flowing through completely legal channels, following rules deliberately written to create these outcomes. Let me translate that into something concrete. $200 billion per year works out to roughly $1,500 for every household in America. That's not what wealthy families are saving. That's what every regular household is effectively subsidizing so that the wealthy can pay less. If you've ever wondered why roads are crumbling, schools are underfunded, and basic services keep getting cut, part of the answer is sitting in portfolios that have never been taxed. To put this in perspective, the entire annual budget for the National Institutes of Health is about $45 billion. The money lost to tax avoidance by the wealthy could fund medical research 4 times over. It could eliminate child poverty in America. It could make community college free for everyone. Instead, it compounds quietly in accounts that most Americans will never see. The return on investment for sophisticated tax planning is staggering. A wealthy family might spend $100,000 per year on tax attorneys, accountants, and financial advisors. If those professionals save them $5 million in taxes, that's a 50x return. You can't get returns like that in the stock market. The single best investment a wealthy person can make is in reducing their tax burden. Meanwhile, the IRS operates on a budget of about $12 billion per year. That sounds like a lot until you realize they're responsible for collecting over $4 trillion in revenue. For every dollar spent on IRS enforcement, the government collects somewhere between $5 and $12 in additional revenue. Yet the IRS budget has been systematically cut, reducing their ability to audit complex returns. The asymmetry is almost comical. The people with the most to hide have the fewest people looking. The people filing simple returns face automated systems designed to catch every small discrepancy. It's like having security cameras pointed at the cash register while the vault door hangs wide open. The rich get richer partly because no one has the resources to make them stop. So where does that leave you and me? What are we supposed to do with this information? The most frustrating part of all this isn't the loopholes themselves. It's the psychological trap they create for everyone who isn't using them. Once you understand how this system works, you face an uncomfortable choice. You can get angry, which changes nothing. You can try to use the same strategies, which requires wealth you probably don't have. Or you can accept the situation and move on, which feels like giving up. None of these options are satisfying, and that's kind of the point. I call it taxpayer Stockholm Syndrome. We've become so accustomed to a system that disadvantages us that we've started defending it. We've internalized the idea that paying your full tax burden is what responsible citizens do, while minimizing your taxes through sophisticated strategies is what smart people do. But here's the truth. Your tax payment isn't noble or civic-minded. It's just the only option you were given. The system was designed to capture your income with maximum efficiency while providing escape routes for people with more resources. You're not choosing to pay your fair share. You're playing the only game available to you while others play a different game entirely. Understanding this doesn't change your tax bill. It doesn't suddenly unlock billionaire strategies. But it does change how you think about the choices you make and the conversations you have. When someone tells you that raising taxes on the wealthy is class warfare, you'll know they're defending a system that's already waging class warfare in the other direction. When someone argues we can't afford universal health care or free college, you'll know we're already spending hundreds of billions on tax benefits that flow primarily to people who need them least. And here's the thing that gives me some hope. These loopholes only exist because people wrote them into law, which means people can write them out. The stepped-up basis isn't a law of nature. It's a policy choice. The preferential treatment of capital gains isn't mathematically required. It's a decision we've made as a society. Every single advantage the wealthy enjoy was created by legislation, and legislation can be changed. That change won't come easily. The people who benefit have enormous resources to protect the system, but it won't come at all if people don't understand what they're fighting for and against. Knowledge isn't power by itself, but it's a prerequisite for power. You can't fix a problem you don't understand. So there you have it. The mystery of tax loopholes that shouldn't work but somehow do isn't really a mystery at all. It's a carefully constructed system of legal advantages, sophisticated planning, and psychological normalization that makes the absurd seem inevitable. The wealthy aren't cheating. They're just playing by rules that were written specifically for them. The next time you file your taxes and watch that number pop up on your screen, remember, somewhere, someone with 100 times your wealth is paying a fraction of your rate, and they're probably not eating ramen to afford it.